All right, ladies and gentlemen, we're going to get started. Thank you again for joining us this afternoon. We appreciate you guys carving out time of your busy day, and we look forward to what's going to be an informative discussion on what has been an unprecedented and tumultuous year thus far. My name is Adam Paoli, and I'm the founder and lead wealth planner at Coltiva Wealth Planning Partners. And I want to welcome you again as we continue our educational webinar series. Many of you were part of the ones we did back in the spring, and we took the summer off because a lot of us are pretty zoomed out. And if we're going to be honest, we were hoping that by now we'd be doing this in person. However, out of an abundance of caution, as our state likes to say, we were going to continue this virtual series today, and we'll keep doing so virtually until it's comfortable and safe for us all to get together in person again. Many of you know the team at Coltiva Wealth, and you know that we remain passionate about educating and helping people. Typically, most of our waking hours are spent face-to-face with our clients, establishing goals that impact their finances and their families, designing strategies to help achieve those goals, and then executing them. We've adapted our practice and invested in tools to allow us to stay connected and continue these conversations, continuing to build deep relationships with our clients, both in person and virtually. As you know, we opened up our office at the end of May, and we have put procedures in place, and so we would like to hopefully see you all here soon once you guys are comfortable doing so. And we continue just to remain passionate about helping people, not just with the management of their investments, but also their lifestyle goals, and discussing things like where they want to retire, which is increasingly not Illinois, how to ensure that the future generations understand money and understand wealth, and how to remove anxiety behind all of the critical financial decisions they need to make, all as a part of our process that we call the Path to Prosperity process. And during all of these recent conversations, it is evident that anxiety levels by our clients are increasing on a daily basis. 2020 so far has brought us a long-lasting global pandemic, a steep market decline, followed immediately by an unprecedented recovery. We've seen government stimulus at a pace we've never really seen before, add social unrest and nationwide protests, and oh yeah, by far the most contentious presidential election that we've ever seen. Other than that, this has been a pretty uneventful year for us. I don't know about you, but anyhow, to understand how we got here and what lies ahead and the factors that are going to impact the direction of the markets, we've assembled a panel of portfolio managers and partners to our firm to help provide insights and answers to the questions that you may have or hopefully that you develop. So we're going to jump right in. And before I introduce our panelists, here's a few quick housekeeping items. Number one, we are going to schedule this for 1 hour today, and we're going to keep it to that at the very most. We want to make sure you get back to your evenings with your families. Everybody is going to be muted as participants throughout this presentation. So if you're having any technical issues at all, I'd ask you to please email Mike DePiro, which is mike@coltivawealth.com, or you can send a comment to me directly in the comment section of the Zoom toolbar. We are going to begin with some pointed questions at each one of our panelists and let them go take that from there. And then we're going to open that up to the audience. Many of you have emailed questions in, so we're going to do our best to get to all of those. And if you didn't get a chance to do so ahead of time, feel free to look at the bottom of your Zoom toolbar. You're going to see something that says Q&A, and feel free to type those questions and answers in. We're going to get to as many as we can, given the time allotted. And if we run out of time, we'll be sure to answer those questions individually, and we'll reach out to you individually. So without further ado, I'm going to turn it over to John. John is a partner of ours. He is the VP and Senior Portfolio Specialist for one of our investment firms, Salvos Investments. And John's going to talk about the impact of COVID-19. Now, we all know that COVID-19 has touched us all to different degrees. And John, we'd like you to kind of kick us off by talking about what Salvos sees as the continued impact of the virus, specifically the projections and the talk of a vaccine, states rolling back or tightening their respective phases, as well as the impact for a potential second wave and how all of this is going to affect the market. So John, why don't you kick us off? Thanks again for being here.
Yeah, thanks for having me. I mean, one of the biggest challenges we've seen this whole year is the fact that really in the first time in world history, we've had a major economy completely closed down in huge swaths. Entire industries completely shut off to business revenue. And I think a compare and contrast that's worth noting is when you look at a watershed event like 2008, which was, of course, a very extreme market environment for all of us to go through. big difference was in 2008, we still had money in motion. And if there's really anything I would sort of impress upon everyone about this year versus any other year, including if you look at a magnitude year like 1929 and following years in the 30s where they had further declines, is the fact that money in motion was all still very much alive. But this year is a standout year different in that we actually, for the first time, turned that spigot completely off in so many ways. Money in motion is the blood flow of any economy. And that had enormous ramifications. I mean, if you look at the budget deficit this year, these supposed stimulus packages, which is sort of laughable, and I say that in a very gentle sense, that you would call anything a stimulus when you're trying to keep an economy on life support. Stimulus is you're trying to get to the next level. What we went through was a pure life support environment where we had 20 plus million Americans completely unemployed because we had deemed their jobs non-critical and had closed down in many ways their jobs and industries. That has made it incredibly difficult for money managers, for average investors to get a true pulse of what's viable, what may not be viable, what the future is going to look like if the government decides that they want to continue lockdowns, shutdowns, however you want to think of it as, but entire industries that get closed down. But I think going forward, hopefully our government and governments in a pluralized sense will start to accept that there will be undoubtedly imperfect outcomes. That, fortunately for all of us, this was not the bubonic plague. We did not have a 30+% death rate. It was far, far lower than that. And there are ways to buffer folks and also businesses in a way that they can stay open, even if there are measures in place that are far more restrictive than normal, at least to be able to keep that money in motion. And like I said, that is such an important takeaway. Money in motion, key words. If you don't have it, you don't have an economy. With it, you have at least a chance. As for the vaccine, Adam, it remains to be seen. I mean, the first results so far out of the vaccination trials has shown, CNBC had a report last week on it, folks that were guinea pigs for the vaccines that are under development were experiencing some pretty horrible conditions. I remember reading one guy suffered such strong chills that he actually broke his teeth. So it remains to be seen how well of a vaccine endeavor we can come up with. Keep in mind, we never had a flu vaccine. We always had flu shots, never a vaccine. Had the flu shots around for 60 years. But we never had an actual vaccine that eradicated the flu. So this may be a situation where we just have to learn to live with it and be smart about some of our practices going forward.
John, I know it's kind of asking you to look into a crystal ball a little bit, but going into the winter time and into next year, what are you guys thinking and looking for as far as what economies look like as far as local economies opening up or shutting down? We've got a lot of clients. I've seen some names on this list that have told me that they think all this is going to stop about 3 days after the election. But what are your thoughts on, you mentioned money in motion and how critical that is. And there's a lot of people, especially north of the Mason-Dixie line, that are concerned that winter is going to certainly slow down a lot of money in motion, and there's going to be a regulatory aspect to that. What are your thoughts on that?
I mean, there is the chance that this continues to be a politicized situation. You mentioned about retirement, and Illinois was not part of that equation for a lot of people. You were kind of touching on some things there. It remains to be seen what happens after the election, depending on who does when, but you have it certainly on a state-by-state level. Florida, for example, has largely reopened. Disney World has been open for multiple months now, no incidents whatsoever. But when you look across the country to California, California has refused to allow Disneyland to reopen in any degree. So Disney, just went through a massive layoff. So it is probably going to be state by state. I think you're going to see some fractures that come out of it. Hopefully wintertime resembles a lot like Australia just went through. If you look at Australia's flu epidemic for this past year, keep in mind Southern hemisphere predates Northern hemisphere. So Australia is now entering their springtime as we are entering our wintertime. They had a 90%, a 93%, I believe was the exact number, drop off in the flu epidemic. That means that they only experienced about 7% of their normal cases of the flu this past winter for them. A lot of that's because of social distancing. No one's going to work. You're not shaking hands when you greet people. People are over hand sanitizing like crazy. So that has significantly reduced the flu epidemic. That could easily convey here in the United States as well. If that's the case, it may keep the pressure off the hysteria that could be created out of further shutdowns, and certainly in certain states.
Thanks, John. Really appreciate that. We're going to move to Pete now. Pete is VP and Senior Portfolio Manager for another one of our partner firms, Clark Capital. Appreciate you being with us today, Pete. I'm going to give you the softball question, and Greg's going to get the real fun one when it comes to the election. But the concern we're hearing very often, and we've certainly heard it a little bit more over the summer, but was just the speed of the recovery, right? We saw March being the sharpest 1 month decline in stock market history, and then followed immediately by the fastest recovery we've ever seen. And a lot of our clients just believe that the recovery is too good to be true. And it seems like the economy is disconnected from the stock market, especially when you look at things like, levels of unemployment and the fact that, as John mentioned, we are not fully reopened across the country. So tell me what Clark Capital has to say about all that.
Yeah, well, thank you for having me on the call today, Adam, and I'm glad that's a softball question, right? Certainly a big topic and something we've heard a lot about as well from clients, and it really was a remarkable, as remarkable as the decline was equally as remarkable with the recovery. I know it was the quickest 20% correction we'd had in history, the quickest 30% correction we had in history, and then one of the stats that I thought was interesting coming out of March as we were going through April was there was a comment that it was the best 50 days in the S&P 500 history since the S&P went to a 5-day trading week. Now, honestly, I didn't know exactly what that meant. I thought we were always a 5-day trading week, but for those that like a little bit of trivia, we actually were a 6-day trading week from 1887 to 1952. We used to trade 2 hours a day on Saturday morning. So 1952 went to the normal 5 days a week, Monday through Friday, but it really does show how quick and kind of a V-shaped market recovery we've had. I think it's also fair to say economically, we've had a pretty V-shaped recovery as well so far. So second quarter down over 31% on a GDP perspective, but that's on an annualized percentage. So our economy didn't shrink by a third. It shrunk by, 8-ish or so percent. But on an annualized basis, the way we report GDP, it was a little over 31%. We don't have the third quarter numbers in yet, but the expectations are somewhere at 32, 33% kind of an annualized growth rate in the third quarter. So saw that in the market. We're seeing that now in the economy. But I think there's two big points to your question, Adam. And I think one of the things we're seeing is, and we saw it on the news today, the S&P 500 and the NASDAQ are within a couple percent of their all-time high. What's really important to understand, and kind of digging one layer beneath that, is that we've had very narrow leadership that's really led this market higher. We've had just a few names, really a handful of names that have been the big lift to the market. And they're the ones we all know, those FANG names, they've kind of increased that to Fan Mag. That way they can add Netflix to that group as well. But this narrow leadership of those large cap tech companies have really been the leaders in the market. So just not to get into too much numbers with you here, but if we think of the S&P 500 through the end of September, so the end of last month, the S&P, as we all know about it, we all talk about it, was up a little bit over 5.5%. But remember, that's market cap weighted. That's the way we talk about the S&P 500. There's a way we look at it in this business. We can actually look at the equal weighted S&P 500, which just lines all 500 companies up, and it's actually usually a little bit more than 500 companies, but lines them all up equally. That number through the end of September was down just under 5%, down about 4.75%. So the market cap weighted shows that those biggest names have really led the market higher, and kind of beneath that, the broader market hasn't done as well. So if we think of the equal weighted index, that's kind of the average experience for the average stock. So down a little less than 5%. So it is important to understand there's been very narrow leadership. That's really kind of distorted some of these market cap weighted indices. So yeah, they're kind of showing, and if we think of those names, they really prospered during this period. I mean, it's kind of hard to say it that way, but the Amazons, the Apples, Netflix, people ordering stuff online, a lot of that, the technology focus really benefited from an environment where people stayed at home, worked at home, ordered from home, did their business from home. So it did help those companies, and the stock market reflected that. The final point I'll make is, again, as we think about the economy, and you talked about unemployment, I'm kind of front and center. I'm a big believer in understanding what's going on in the job market. I think that is something we're going to have to watch as we move forward. For some perspective, we're at 3.5% unemployment in December. Right now, September, we were at 7.9%, so clearly more than double where we were at, but showing some improvement. But the other big thing is we had those fiscal stimulus, the CARES Act 2.0, which was, I think, actually technically the fourth fiscal stimulus package. But that did really help kind of bridge that period where a lot of people were unemployed, but they still got money. They were still able to spend. So we're kind of at a point where we're going to have to see what happens as some of those benefits run out if we don't get this fifth stimulus package, and how that could really impact that consumption component of our economy. Because at the end of the day, you and I spending money is about 70% of what drives the economy. So we can't have periods of time where the economy and the market dislocate from each other. I think we're in one of those periods right now, but what we did see was those companies that really did thrive during the shutdown period, they were the ones that really were rewarded in the market. In the broader stock market, the market of stocks really didn't have the same type of performance that we saw in some of those headline indices.
Gotcha, Pete. No, I appreciate that perspective, and that is certainly a question we're getting a fair amount. That if you're watching CNBC, you see where the S&P has gone, and the average individual does not reflect that performance because the average individual is not incredibly highly weighted in about 6 different companies, nor should they be. Just quick kind of follow-up question to that. That obviously we've seen those names go on an unbelievable run. We've had a lot of clients that have asked the question, if we're going to continue down this path for quite some time, should we continue to load up in those stay-at-home type of stocks? What would you say to the people that are asking that question?
Yeah, and we're kind of taking a balanced approach. So really having some of those stay-at-home type of names, as well as some of those economic reopening type of names. And what's interesting, and really from a portfolio management perspective, so those 6 tech names, Facebook, Amazon, Netflix, Microsoft, Apple, and Google, or Alphabet, whatever you want to call it. I have data through the middle of September. They were up just under 44%. Now, all 6 of those names are in the S&P 500. If we look at the S&P 500, this is through the middle of September, it was up a little over 5%. I've been doing a lot of calls, and we've been talking about the S&P 494. Everybody's heard of that index, right? I'm kind of kidding, nobody's ever heard of that. But if you strip out those 6 names, through September 15th, the S&P 494 was down a little over 2.4%. So one of the realities, and we are in this category as well, you can own some of those names. We do own some of those names, but right now the 5 companies are about 24% of the S&P 500. Now, a prudent portfolio manager isn't going to put a quarter of your wealth in 5 or 6 stocks. I mean, that's just not what we do. So you can kind of own those, but the way the indices are built by this market cap weighted nature, they've really kind of emphasized those names and how well they've done. So, again, I think it is, I think you can look for different pockets of the market, those big technology names, obviously they've continued to strive, and, we see that. But again, we at Clark, we really look for trying to get a stock and an equity investment at a good price. We want a high quality business, and we want some improvement in that business. And that really can take a whole bunch of different shapes. That can be kind of value names, that can be growth names. But again, I think kind of looking at both those stay-at-home stocks as well as those economic reopenings, I think there's opportunities in both of those buckets.
Fantastic. Appreciate it, Pete. We're certainly going to spend a little bit more time talking about growth versus value. So I appreciate that. And I think I appreciate the statistics and some of those numbers you gave. And I think it's a good warning shot for those people who believe that, okay, all I have to do is buy the S&P 500 and I'll be just fine. That we don't see those 6 companies continuing down this same path. Those people can be in for a world of hurt. But let's continue on. And I want to introduce our last panelist. Greg Band is from yet another one of our investment partners, and he's the executive director for JP Morgan. Appreciate you being with us, Greg. And yeah, as I joked previously, I gave you the easiest question of the group to talk about politics in the election. But I would say the one thing, the silver lining about COVID, if there was one, was that normally we'd be hearing about political ads and this conversation would have started back in February. And we really didn't hear this in its earnesty until August, right? It was really when we started getting bombarded with this. So I guess if anything, we got to spare, 6 months worth of headaches. But I will say that there's no doubt that the most calls that we've got lately have been around the nervousness going into this election. Give us JP Morgan's stance on the impact of the election, what you guys are recommending to clients to do to prepare for that, and what do you guys see coming in and out of the election?
Okay, great. Thanks, Adam, and thanks to the other panelists for being here. Thanks to the audience for dialing in. As part of employment at JP Morgan, whenever I speak to the public, I do have to give a compliance disclosure. So I apologize, but I can talk big picture. If anybody has a specific investment question, if we open it up for questions at the end, I'm not allowed to answer it. That's why you have Adam. Okay, with that out of the way, our take on the election. And in this industry, often we sort of intertwine economic activity and investment activity. And politics bridges both of those as well. So from an economics side of things, there's going to be some impact on if there is a change, right? Because what we're thinking about, the most likely outcome that is being priced, or at least at the betting sites where you can bet on who's going to win the election, it's a 65% probability now that Democrats sweep, meaning they maintain the House, they take the Senate, and they win the White House. So that's where the money is right now. Anything can happen. We're not endorsing that. That's not our opinion. That's just what the betting site says. And so to model in what changes would they bring to the economy and what would the impact of those changes be on the investment side of the world, I'll try to address both of those individually. From the economic side of things, you would have perhaps a policy of higher taxes, but significantly higher spending. You would have a return to a more globalist agenda, more globalization. You would have perhaps a different approach to immigration, both legal and whatever the proper term is, illegal immigration now. You would have a different approach to those. At least that's what the candidate has said, and that's what the platform of the policy platform of Democrats would be. So to think about those changes, the impactful ones for those of your clients on the phone are going to be, the financial ones. And there's understandably some concern around higher taxes when you think about the investment side, right? So the economic impact, though, perhaps is more important. The Biden agenda could bring with it $8.5 trillion in additional spending. Now, if you think Trump spent a lot, we're looking at $8.5 trillion in additional spending over the next decade. And the spending would be, a lot of it is on infrastructure, jobs, handout, entitlement housing, the one I was thinking about. And many of those have a multiplier effect to them. And so it should lead to greater economic activity. The impact of that on the investment side is, it's natural to be a little concerned about taking the corporate tax rate from 21% to 28%, because that pinches margins and it makes companies less valuable. It's JP Morgan's view, and it appears to be Wall Street's view and institutional segment of the marketplace's view as well, that the lost earnings from higher taxes would be more than offset by increased economic activity. So you have a faster growing economy with more things, a velocity of transactions, making more things happen. The loss in earnings would be more than offset by that increased economic activity. And if you look at the past 6 weeks, you've seen that play out. There was a period of time when that betting site that has the odds currently at 65% of a Democrat sweep, that had rolled over, and it was down as that was rolling over. The market was correlated to it, and the market was selling off. And then as that betting site had the Democrat sweep probabilities increasing, it has been correlated to the market rebounding here over the past couple of weeks, which is an interesting observation. Maybe they're completely unrelated to one another, and it just happens to be moving at the same time. I don't personally think so. I think that Wall Street is betting on all of this spending, and Wall Street likes spending. They like having money come in that, you know, nobody had to earn, right? It just gets spent, and that pulls a lot of future earnings into the present time, which makes, again, a lot of these benefits a little bit more immediate. So the impact is that from an economic standpoint, yeah, companies maybe have a little bit harder margins or a little bit softer or tighter margins, but a better economy to do business in would mean that a lot of those negatives are offset. What would we do about it in client portfolios, and what are we advising people to do? And it's to maintain a long-term perspective, right? To be balanced and to be diversified. And here's a sort of rule of thumb to think about what moves markets. In the short run, it's emotion. In the intermediate run, it's policy. And in the long run, it's earnings. So emotions around the election, we would anticipate some volatility. We would anticipate greater degrees of volatility right now because it's an emotional time frame. Election years can be emotional. In the intermediate run, it's policy, and I just addressed that, right? If policy proposals are going to meaningfully impact the ability of capital formation to happen, then it's going to be reflected in the economy and the market. If it provides a tailwind, it'll be reflected in the economy and the market. And if it can bend long-term earnings either up or down, well, then that's going to have an impact on your long-term rate of return. And so from a policy standpoint, we're not all that concerned about it. We would say that we would anticipate more volatility. And the answer absolutely positively is not to try to get out of the market and avoid the volatility, right? It's to have that longer term vision and stick to the plan that you've put together for them, Adam.
Fantastic, Greg. Certainly appreciate that. I think it's a great way to look at both the short-term, medium-term, and long-term implications of what you mentioned. So at this point, we're going to open this up to questions from the audience. So just as a reminder, if you do have a question, look at the bottom Zoom toolbar. You'll see two little bubbles that says Q&A, and feel free to fire off some questions. John, I'm going to give you the first one that dovetailed a little bit off of something that you said and that Greg mentioned. We've talked a lot about this stimulus, which you called not a stimulus, but a lifeline or life support. And there is talks of continued spending, especially, as Greg mentioned, if we do see a sweep. What do we think? I think it's clear short-term that spending is a good thing, but what are the short-term, long-term implications of the debt that we're building as a nation, and how do you think our clients should be feeling and thinking about that?
Well, if you look at, the first couple hundred years of our history as a country, we raised somewhere around $4 trillion in national debt, and that was doubled out by 2007, where we hit around $7 trillion. And this, last 6 months, we've essentially created an additional $4 trillion out of thin air, and that's rapidly rising with additional stimulus comments and coming from Congress. So, this is free money. As a world reserve currency, we've got a lot of latitude to just do what we want to do because we don't have someone to call our bluff on it. Other countries like Venezuela, Argentina, Russia, etc., throughout their history, Greeks are guilty of it every 12 years on their history. If you go back far enough, a couple thousand years, it will have an amazing impact on our future because debt is inherently deflationary. Everyone assumes that it's inflationary, but it's really always important to point out debt is deflationary if you plan to honor your debt in today's purchasing power. It only becomes inflationary once you decide that your currency has no value and you're just going to print it to make the payments both on the interest and also on the principal. So we're at 27 trillion in national debt right now. That'll easily be north of 30 trillion. The longer term impact for everybody is just the fact that our ability to raise rates is going to get very stifled. The cost of carry of the national debt is going to become so cancerous should rates ever even attempt to normalize. What it directly impacts all of us as just regular folk, is your dreams of going back to the credit union and getting a 5 or 6% CD are probably dashed for quite some time. Because when you look at the federal budget today, interest on the debt, which has been flatlined for well over a decade with rates coming down, yet the debt has grown over close to 200% in the last 12 years, it is still number 4 line item for the federal budget. Social Security is number 1, Medicare, Medicaid is number 2, DOD or Department of Defense is number 3. Interest on the debt is number 4. Just imagine at $30 trillion, if we normalize rates back to even something low of 4%, that would be a $1.2 trillion interest spend per year. And our typical federal budget stands at about $4 trillion. So who doesn't want Medicare next year? So that's the reality that we're facing, right? So we are probably going to be in a very low rate environment for a long time. Obviously, Powell has said for a couple more years. It could be much, much longer out into the horizon, simply because we cannot afford to pay the interest payments should those rates go up.
Yeah, and that was actually dovetails into another question that we got, is exactly on that topic of interest rates, and a lot of concerns of exactly what you said, of the potential and the ability for us to see meaningful increases in rates. Greg, Pete, either one of you want to jump in as to what you think it's going to take for us to see a meaningful increase in interest rates?
Yeah, I'll go ahead, Greg.
Okay, go ahead.
Yeah, when we think of the interest rates, and John just said it, I mean, the Fed has kind of laid out this playbook of lower for longer. We think that's the environment we're in, this lower for longer interest rate environment. And we know the Fed really does, has a lot of control on that front end of the yield curve, and the market controls a little bit more further out, but they're all related. I mean, they're related to each other when we look at that yield curve. So, that's our anticipation, is lower for longer. I think one of the real interesting questions we get a lot, and it was interesting, John addressed it. A lot of people think, boy, all this debt, inflationary. Remember, those are the exact same comments people were making in 08 and 09 when we did our own, stimulus plan back then. And I can't remember, 800 billion or whatever it was back then, compared to our 2.2 trillion now. But that was the concern, was there was a lot of stimulus, a lot of money in the system. Would that lead to inflation? And we can kind of look back in time and see, gosh, the last 10 years, the Fed had a hard time meeting its inflation objective and had a hard time meeting it on the downside. I mean, the inflation, their target is about 2%. And, we were below that for much of the last 10 years. So, if we see some increases of inflation, that could be something that pushes interest rates up. But again, at this point where we're at right now, it's not really what I wouldn't call a near-term concern. I mean, we do think we're in this lower for longer. And just kind of one other point, follow up on what John had said. Remember 08, 09. When did the Fed start just unwinding its balance sheet? And when I say unwinding, it let bonds that it had bought during all those QE programs start to just mature, and then they weren't replacing it. I think that was 2017 or 2018. So again, a 7 or 8 year period where the Fed was in essence pretty stimulative during that period of time. So even though they've kind of told us the next couple of years, we would kind of agree with John, it can last much longer than that. The Fed recent history has shown that they'll kind of stay stimulative longer than kind of shut off the spigots too early.
Yeah, and I've heard of that, kind of reference to say the 7 to 8 years worth of stimulus we got coming out of 2008 has really happened in like a 10-week period this year. So, certainly very unprecedented. Greg, did you want to add any other comments to that?
If you're looking out for inflation, it's not the money supply. That's what we're talking about when we say that, we've increased the Fed's balance sheet and we're throwing all the money out there. The money supply by itself is not inflationary if it sits, it sits in the bank, right? What you need is the velocity of transactions that increases capacity utilization and then leads to higher prices. And so you have two types of inflation. You have wage-driven inflation and then commodity-driven inflation. And to get wage-driven inflation, we need to be back at full employment. And so we started to see that 9 months ago, 12 months ago. We started to see the building blocks of that were, that was something that we were anticipating to start to deal with around this point in time. And so at full employment, when there's competition for labor and there's a lack of qualified employees, companies pay up to bring that employee on. And you start seeing, again, a velocity of transaction and a demand for goods and services that can create that inflationary pressure, and or a lack of raw materials and resources, i.e. an oil embargo, right? Think 70s, that would create the cost of goods and services to escalate. And both of those, whether they're wage driven or commodity driven, you need a much higher degree of capacity utilization, whether that's from labor supply or just making stuff. And so our take is that a little bit of a disagreement, or maybe looking at it from a different lens, would be a year from now, we do think that we're going to be back to open, right? By the spring, summertime, businesses should be either on their way or fully reopened. And there's a lot of pent-up demand, and we can envision several quarters of 8 to 10% GDP growth in that environment. At that point in time, we're probably approaching full employment, or maybe even already there. And with that jump in economic activity here at home, corresponding with economic activity abroad, and approaching full employment, we would be a little bit more mindful about a potential inflationary environment. And over the course of history, I forget, John, I think you mentioned it, how do you pay down a public sector debt, right? And you have 5 options. You confiscate wealth, which is taxes. You decrease spending. Good luck with that. You default. You say we're not paying it. Or you pay it off with a devalued currency. You print off $20 trillion in trillion-dollar bills, and you pay them out. And that devalues your currency, and everyone's savings becomes worthless. And the 5th option is you grow your way out of it so that you have a higher degree of revenues taken in to pay off the debt, if you can manage the surplus appropriately. So we would anticipate a little bit more inflation than I think I've heard here before, if that economic scenario unfolds the way that we think it will.
Fantastic. Appreciate that, gentlemen. That was certainly insightful. I want to change gears a little bit and talk a little bit about the equity markets, and specifically U.S. versus international. We've seen for quite some time that the U.S. markets have outpaced international. We saw a little bit of a comeback on the international side of things, but with this year continues to see where the U.S. is dominating. What do you guys see as a forecast for international stocks, and do you guys see any opportunity there? Pete, why don't you kick us off with that?
Sure, Adam. Yeah, we do think there's opportunities internationally, and you're right. I mean, I think the numbers is, 8 of the last 10 years, U.S. has outperformed international. So it is something that a lot of people, a lot of advisors, a lot of investment managers have been a little bit on their heels about, is the international. But as we were kind of approaching this year, so obviously before the pandemic, late 2019, early 2020, one of the things we were looking at is just really big valuation differentials between even developed as well as emerging economies in the U.S. I mean, we were, again, getting a little bit high in our valuation metrics. And I always say it in the same breath, does the U.S. deserve probably a premium valuation to the rest of the world? Yeah, I think that's probably fair with our robustness of our capital system, our financial markets. So it probably makes sense why we get that premium. But we can see, and again, as a firm that does that bottoms up fundamental analysis, looking company by company, we do think there's opportunities international. I mean, we think there are areas, some of it's from that valuation perspective, some of it's, based on where that company might be sitting, the way it's, generating revenue. But we do think that, again, generally speaking, in a diversified portfolio, we think having some international exposure does make sense.
Greg, what are your thoughts on that?
Yeah, we would agree. We used to speak about the economy as being in the longest period of economic expansion in history, right? We heard that phrase a lot. That went on for a long time, or we were approaching it for a long time and we spoke about it, but that cycle's ended, right? We had a really bad recession. First quarter, we lost around 5% of our output. Second quarter, we lost over 30, but we've started growing again. And so we are in the early phases of a new growth cycle. And during those early phases of a growth cycle, cyclicals tend to do well. And if you look at what makes up U.S. versus non-U.S. has substantially more cyclical representation in their universe. It's 56% of their universe. So it's a large chunk of it. And so there's a fundamental case for international today based on where we're at in the cycle, along with the valuation case that Pete made very eloquently. And in addition to that, we do think there's a currency tailwind as well, in that all the stuff we've been speaking about around debt and flooding the world with our dollars, it's making it less valuable. And there's a lot less demand for our dollars and support to strengthen the dollar when interest rates in the US are not as different as they were to non-US bonds 9 months ago.
And John, I want to kind of change gears slightly a little bit on a similar conversation, but rather than U.S. versus international, a conversation of kind of growth versus value. Historically, value is proven to be, very important and valuable in providing performance for our clients. And really, since 2008, values had a really tough time. And we saw at the beginning of this year, value started making a comeback. What would you say Stavros' view is on value stocks and their outlook moving forward?
Hey, one of the tough formats for the value, and Pete touched on it with the S&P 494 versus the S&P 6, is you have really good quality businesses that have really languished in this current environment. I mean, their industries have been, in some cases, annihilated or severely impacted, where you look at the consumer staples, you look at the tourism side of the equation, and all of that has trickle-down impacts to what you would deem as a value business. Going forward, though, I think that will come back. I think value, because a value business is essentially, or value stock is something that has true intrinsic value. It produces a good or a product that people actually need. Typically, it's represented through cash flow vis-a-vis a dividend. If you look at the energy sector, which is typically within the value camp, that's absolutely been destroyed with the barrel of oil as so low as it is, with the economy shut down. ExxonMobil trading at $35 a share, a 10% dividend yield, which they have reassured folks that they're going to maintain, but we'll see if that actually sticks. But yeah, I think the value trade is looking more attractive longer out, simply because the business price for some of these assets is becoming incredibly enticing. Versus, and not to pick on them, but you look at a Tesla, which I haven't looked at their PE in a little while, but I mean, I think at one point it was 1,000, right? And so that compared to buying something, when I think of Beverly Hillbillies and a black gold coming out of the ground, and ExxonMobil is just a business that's probably not going to zero anytime soon.
Pete, do you want to chime in on that as well?
Yeah, no, and I think it is kind of a truly a positive way to look at what's going on in this market. There's opportunities kind of below those big top heavyweight names where, yeah, they haven't kind of participated as much in this rally. And some of those do fall in that value universe. We've been watching this growth value story for the last couple of years and really seeing that disconnect where growth has really dominated value and really kind of post-credit crisis. And one of the things you tend to see is, when do growth companies, when do they, again, economically speaking, tend to benefit? Well, more in a slower growth environment, right? A growth company generates its own growth. Investors might be willing to pay up a premium for that growth. But if you think of companies, again, as John was saying, these value companies that are kind of growing, they're more cyclical, they may grow more with the economy. We're in an economy now where we've all talked about that's going to grow 30-something% this quarter and could be double digits in the fourth quarter and could continue to be really above trend in 2021. So we do think there's opportunities there. The way I've been talking about it is, and we've seen kind of the discount that value stocks have traded at compared to the market is about as stretched as we saw back to like 99, 2000 during the dot-com boom. So yeah, can that rubber band stretch longer? I guess it can, but boy, from our perspective, it feels like it's really getting stretched. And we would agree with John. We think, that will come back at some point. There will be, they don't have to come right back to where they've been historically, but if you get some traction in that value area, again, kind of closing that gap with growth, we think, that's something we're looking at as a potential as we move forward here.
And Greg, can you kind of piggyback on that? I want you to kind of combine a couple of these conversations. John mentioned energy is a big part of the value sector, and that's certainly taken a big hit. Financials have taken a big hit this year. You mentioned that from a fundamental basis, you would see more cyclical companies come back. What are your thoughts on historically strong sectors like energy and financials, and what is it going to take for those two to come back?
Okay, so it's a great question. And if you think about value, right, in the sectors that constitute value investing, energy, industrials, materials, and financials, it's about 40% of the value universe. And those sectors collectively in 2020 are looking at their earnings declining. So I'm kind of just spitballing it here, but 30 to 35%. And if you look at the growth universe, technology makes up about 45% of the growth world, whose earnings are expected to grow in 2020 relative to 2019. So the return differential between value and growth is explained as simply as that. A big chunk of the value universe has a huge hit to earnings. A big chunk of the growth universe is making more money than it did last year. What's it going to take to change? And that's the I don't know, $20 trillion question, whatever the value size is. I should know that. But we think that that environment that I described before, that when you get the economy to reopen, right, and people can go about, you know, normal, back to normal lives, not this normal, but normal lives, and you have faster economic activity as a result of it and better employment as a result of it, that creates more demand for energy, which should be buoyant to prices. Same thing for materials, industrials, which eventually leads to inflation. And even though the Fed probably doesn't move short-term rates and are willing to let inflation run a little bit hotter than they normally would, or longer than they normally would, the market is going to control interest rates. And as market participants anticipate Fed reaction or anticipate higher inflation, you can see interest rates move up, which is buoyant for financials and makes them more profitable. Which is a long-winded way to say that the market is a forward-looking mechanism, and at any point in time, it can rotate to value in anticipation of these events. What we would be looking for would be progress on a vaccine, antivirals, therapeutics, further testing that indicates a significantly larger of the population has already caught it and, you know, is no longer at risk. Those sort of things. If you see those sort of announcements, that could be the catalyst for a rotation back to value. And I'll give you one illustration. If you look at the end of May and the beginning of June, there was a 10-day time frame when value outperformed growth by 12%. Right, and the commentary around that time frame was, "Hey, we're hitting summer. Flu season is over. Maybe we overdid this whole COVID thing, and it's behind us, and it's not going to come back. What do we want to buy? Let's rotate to value." Right now, nobody came out and said that. Jim Cramer doesn't get on TV and say, "Here's the buy signal." Well, actually, he does do that, doesn't he? He's got his buy button, but he doesn't give you the all clear, and because he knows, right? That's just an opinion. I got to come up with a better example. Maria Bartiromo. There we go. But in that 10-day time frame, real quick, right? 12% outperformance on value versus growth. Right, that's not insignificant. That's a substantial level of outperformance.
Oh, it certainly is, and I think that's all very insightful of things to look at for that sector specifically. One thing that we've been keeping an eye on as a firm is, you know, one of the things you talked about, Greg, is just here are the things that are going to happen as far as reopening, and we're starting to see different indicators of, you know, measuring flights booked, measuring miles tracked, and we've got all these smartphones now, and they know exactly who and what we're doing and where we're doing. What are you guys looking at? Do you guys see any unique indicators that you as a firm are looking at to forecast that consumer behavior and that returning to pre-pandemic norms? Anybody want to chime in on that?
Yeah, I'll share one screen just really quick because I think this is interesting. So I apologize. I'm gonna take over here for a second, and then I'll all right. So we want to get to this. just to put things in context, and if everybody can see this, these are various purchases of various activity, right? So this blue line is mortgage applications. This purple line is in-person credit card transactions. This green line is hotel occupancy, right? This gray-ish line is travel and app usage. This purple line is actually in-person dinners, and then TSA travel. And you can see outside of mortgage applications, all of these are substantially below where they started, pre-COVID back in February. But in-person credit card transactions is actually pretty close to where it was. So we're watching these sort of things to see, all right, are these things moving and are they starting to tick up? And what's the implication of those and the carry-on effect or the second order effect of these? And so we're watching that, but I do think JP Morgan's view is that this is really going to hinge on news around, the science of it, antivirals, a vaccine, testing that indicates a lot more people have already had it, and they're, we're closer to that herd immunity or 50% sort of exposure. More than 50 is better, but 50 is kind of that minimum level. So that's what we're looking at. We're monitoring all of these things, but also looking at the science around the disease itself. Okay, I'm going to stop sharing. So I think that went back to normal.
I think it did. I think I got to pop mine back up. So, John, Pete, either one of you have anything fun and exciting to share there?
Yeah, I would say from my perspective, and probably not anything unique. That was really interesting slide from Greg. But I do think, and it kind of relates to the first question you asked me, Adam. I think making sure we're monitoring the consumer. I mean, one of the things we know is that we had this huge spike in unemployment, huge drop off in the workforce during that March, April timeframe. It has been repairing, but we're still kind of clearly below where we were at the beginning of the year. But one thing that kind of helped get us through that period was that fiscal stimulus, those checks that were going directly to consumers. So, I kind of, this is, been looking at this data for years. I guess for me, I would start looking and continuing to look at what's going on with the consumer. Are we seeing that job market repair? We'll tend to see it slow, right? It's kind of, the people going right back to work, the restaurants that have reopened, we've seen those kind of hit the employment numbers, but trying to finalize that final gap from the 7.9 to 3.5, if we want to look at that as the goal. How does that continue to work out through the next several months and the next several quarters? Again, I don't think you want to move away from, in the long run, we really want to understand what the U.S. consumer is doing. Are they employed? Are they confident? Are they willing to spend money that they're making? And that, that really becomes an important centerpiece of the U.S. economy.
John, I'm going to ask you to switch gears and talk to us a little bit about volatility. We saw an unprecedented level of volatility earlier in the year, and we're certainly off from those historic highs, but we're still trading at volatility levels that are well above normal. What is your anticipation throughout year-end and into next year of where you see volatility?
A lot of it will be driven by the election or the lack of an election result. If it takes a long time, if we have a deja vu 2000, right, with the hanging chads. If this is the mail-in nightmare, we've already, I think, seen that they can count ballots as late as November 10th. They just have to be postmarked by the 3rd. So that could draw us out in a bit of a question mark who is actually the presidency. But also, it's going to be, what does winter bring? If we have another spike like we're seeing in Europe right now of COVID cases, it certainly could draw out more questions around shutdowns and revenue hits and so forth. One thing I would remind everybody is the media in particular loves to commingle the terms risk and volatility to be synonymous terms, and they are absolutely distinct. There's a big fat wall between the two of them in definition. Volatility is just price movement. Risk is you make an investment, you go to zero and you can't come back from that. So price volatility is just something we live with. I mean, all of us as portfolio managers and investment firms try to do our best to shelter investments from too much volatility. We don't make overweights. I mean, Pete made the comment about you don't take an entire net worth and throw it in 6 stocks, as much as you don't go out and put everyone's wealth in Brazilian gold miners. That would be subjecting them to extreme risk and extreme volatility. But just keep in mind, prices going up and down. This is Rip Van Winkle. I think Greg kind of mentioned about for the long run, this is Rip Van Winkle investing. And if you're investing in good companies, volatility is noise, but it's not about losing capital, truly losing capital.
Amen. All right, gentlemen, we're starting to run a little bit thin on time. I'd like each one of you to chime in one last time. Just give us some good news. Pete, start with you. What do our clients have to look positive about? Because if they turn on the television, they're not going to hear a lot of positivity. So what good news do you have for us?
Yeah, I think the good news is a couple fold. And again, I think a couple of us have touched on this, and I want to make sure I say it. I mean, we're big believers in sticking to that long-term financial plan that, again, Adam, you and your team put together for the clients. We think that really is what leads to investor success. Don't be moved. Don't make changes based on short-term movements in the market. We don't think that's a good way to kind of go through these periods of time, because as John said, there is a lot of volatility, but that's just the movement in the market. So, that is something we talk a lot about at Clark is, sticking to those long-term financial goals and objectives. We think that's the way to meet those to get that long-term success. Good news, I think we have to look and say, we have had a very substantial bounce from an economic perspective off of the bottom we had, in that record slowdown we had in the first quarter. We're seeing some clear improvement as we've kind of moved through, the second quarter, we're seeing clear improvement in the economy. So we're heading in the right direction. Yeah, I think the volatility we might see with the election is something that we're hearing a lot about. But, we go through history and we get through these periods of time. So we're kind of believers in sticking to those, trying to invest in good businesses, understanding what those businesses we think will generate over the long term. And we have had quite a significant improvement from those lows that we were going through in that March and April timeframe. So I do think there is good news out there. And as I mentioned earlier, there's opportunities out there as well. We still think there's opportunities in the marketplace.
John, what are your thoughts?
I would touch on something a little different, just so it's not repetitive. Look, the United States is the most fluid labor market in the world. As citizens, we have 50 competing provinces. Adam, you kind of touched on a little bit of a hot topic with your intro salvo, touching on Illinois. Look, the reality is it is massive state arbitrage that's likely to play out over the next 10 years in our country, people moving around. You're seeing it already. If you live in a high tax state, a high bureaucracy, massive pension entitlements, et cetera, that are completely unfunded, you could pick up and move. And nothing changes other than your driver's license. If you're a German stuck in Germany and you don't like what's going on, yes, you're part of the EU. You could go to France. Do you speak French? So that's a big difference between here and the rest of the world. We're the only country in the world that literally has competing provinces. And I think from financial planning, from lifestyle, from savings capability, that is going to be a big story in the next 5-10 years out as people look for refuge in places that they align better with personally from a tax standpoint, from a lifestyle standpoint. That's a big benefit we have as Americans. So never forget that.
And Greg, you get to close us out.
Well, so, the good news is that we are now officially in the fourth quarter, which is the beginning of the end of 2020. So the year is almost over. We're one for the books. And I think it is really easy to get caught up in this near term 24/7. We've got news piped to us on our hip, in our pocket all day long, every day of the week, every month, all year long, right? And so it's easy to get sort of overwhelmed with some of the media, and the media is always talking negatively. There's always negative stuff on the media, and so it's easy to fall into that. And I would just encourage people to not get caught up in it. That we are going to we'll find out who the president is. Is it on day 1 or day 7 or day 10? I don't know, but we'll figure that out. And if anything that the past decade has shown us, it's that regardless of political differences, the stock market, companies, publicly traded companies, will find a way to make money. And if you were politically on the right and you disagreed with everything, all of the policies that Obama had, and you didn't want to invest during his tenure in office, you would have missed out on a triple of the stock market. Now, it was convenient timing, right? But from the 09 low to 16, it was the market more than tripled. And if you didn't like President Trump because you're on the left side of the aisle and you thought we were going to go to have a nuclear war with North Korea, so you got out of the market on election day and you sat, well, then, you missed out on an additional 50% of return on top of where we'd already come from. So don't get caught up on this. Companies, because we're all here for the investment side. The economic side is interesting. You can get in fights with your uncle across the table at Thanksgiving about it, but it's the investment side. And companies will find a way to make money regardless of what the political environment is. And that's what we're all here to try to help people benefit from, is to help them get from point A to whatever their goal is: retirement, buy a house, pay for college, help out a loved one. And we'll get through whatever the near-term turmoil is, and corporate America will end up being profitable.
I appreciate all your words. And you guys the themes that we've touched on a lot with our clients are all encapsulated here, that we need to have a long-term perspective on all of these things. And just because we have technology that lets us know where the S&P is moving every 30 seconds doesn't mean that we need to live our lives by that, have our anxiety levels controlled by that, and that the bigger picture, long-term aspect of what we do and why we do the things we do are what is critical. And that, yes, we will have an election and we will get by it, and we will still be here on December 1st. And hopefully we will, be every day getting closer to a day we're not having to do this as much on screens, and we can do so in person. So, gentlemen, I really appreciate your time and efforts, and you guys joining us today. And for all of our participants, we're really glad that you took the time to be with us today. Although these are certainly unpredictable times, we hope that you guys find some solace and comfort knowing that the team at Coltiva Wealth is here for you, and we're here to available to discuss what's on your mind, the concerns you have, and we continue to focus our goals on doing whatever it takes to help you look to the future with anticipation and not with anxiety. So if you have any questions, don't hesitate to reach out to us. We're glad to be a sounding board. And if there's other people in your lives that are having these same concerns but aren't willing and don't have the access to ask these questions, we're willing to help those folks as well. If they're important to you, they're important to us. So thank you very much again, gentlemen, for joining us. Everybody, please stay well, make healthy decisions, and we hope to see you in person soon. Thanks so much.
Thank you.